Huyu anasema haelewi kitu na hatujaanza. Sasa huyu ni mwanafunzi mgani? Hata hatujaanza bado. Maisha itaki uoga. Now, ladies and gentlemen, I would want you to listen and listen to me very well. This is very simple mathematics. It's mathematics actually which is meant for high school students, high school. We are way above this mathematics. It is the easiest. Mathematics ya high school, actually form 1 ama form 2 pale. Hata sisi tuko mbali sana. Hii kila mwanafunzi ataelewa. Kuna mwanafunzi ataelewa. Sasa, for us to be able to get, ladies and gentlemen, the annual savings, what we are going to do is to compare the two. We shall be comparing the two bonds. So the two bonds which I would want us to compare here, we have what we call the old bond. So we have the old bond, and what here somebody, the new bond. Now, ladies and gentlemen, for the old bond, I would want you to tell me every year I will be paying how much as interest every year. For the old bond is up here. Motor Vehicle Assembly Company issued a 10-year bond, 16%, shillings 100 million par value, bond 5 years ago. The bond was issued at 2% discount and the issuing cost amounted to 2 million. So, ladies and gentlemen, for this old bond, are you able to see the interest rate? The interest rate of the bond here is 16%. This old bond that we issued 10 years ago, which in this case here 5 years down the line would want to redeem. So this old bond, I'll be able to see, ladies and gentlemen, here that the interest rate is 16%. So the interest rate here, the interest amount which I'll be paying every year will be 16% of the total loan amount, which is 100. So what is 16% of 100? What is 16% of 100? This is quite easy. 16% of 100, 16% of 100. So we need to categorize the old and new bonds. 16 million. Thank you, and thank you very much. So 16 million. So here we have 16 million. So every year, remember this is annual. Don't forget that whatever I'm doing here, if you read number 2 very well, we are doing Roman 2. This is an annual expense. So 16% of 100, this will give us what here, 16 million. But as I said, other than paying this interest, the government wants to promote these small, medium enterprises. The government would want you to raise money. So as you pay interest, there are those tax benefits that will come with this bond interest. And those tax benefits are normally 3 elements, 3 qualifying expenses. So you come and less here, less the tax benefit, less the tax benefit, less the tax benefit. So the tax benefit, ladies and gentlemen, the first qualifying expenditure is the interest itself. The government will allow you to deduct the interest amount from your profits as you get the taxable profit. So the first expense, please never forget, the first expense which qualifies for purpose of you receiving tax benefit is the interest itself. So I'll have here the interest. Interest umesema ni ngapi somebody? 16. Which other expense will qualify to be within my tax adjustable bracket apart from interest? Which other expenditure will qualify? Which other expenditure will qualify? Kindly talk to me. Which other expenditure will qualify? Issue costs, yes. Because the government knows that being able to get finances using this bonds approach is not an easy thing. You must incur some issuance costs. For example, you have to float. They're also called flotation cost. To float them, you have to advertise on the dailies. You must get a caravan where so many people, in this case, people who know how to dance, will be able to go onto those caravans up there, and then they entertain crowds, they bring crowds together, and then now you'll have an investment banker who will be able to talk to this crowd and convince them that for sure you need to buy our bonds. So issuing costs, yes, they are normally allowed. So come and give us the issuing costs. Issuing cost. But ladies and gentlemen, I'm repeating and I'm repeating again. This is supposed to be per annum because Roman 2 of this question, they want us, ladies and gentlemen, to give them the annual benefit. The annual benefit of the new bond vis-a-vis the old bond. Annual. Hapa ndo wanatupanga ambao. Kumbuka 16% is per annum. How about issuing cost? Let me come back, ladies and gentlemen. Let me come back. Okay, great. Let me come back here. So what do we have here? So we are saying, ladies and gentlemen, that for us to be able to issue this, for us to be able to issue these bonds, it's quite not an easy thing, and the government has to allow it. It's a qualifying expense for purposes of taxation. So issuing cost ya old bond ni ngapi? Hawa nauliza ni question gani? It's question number 4. Question number 4 of which sitting? Somebody give them the sitting. I don't have to scroll. I can scroll here very fast. It's question number 4. It's question number 4 of November 2019. Question number 4 of November 2019. Question number 4 of November 2019. So, ladies and gentlemen, here we are. We are being told here that Smooth Driver Limited, a motor vehicle assembly company, issued a 10-year bond, 16%, shillings 100 million par value for 5 years. Par value bond 5 years ago. The bond was issued at 2% discount, and the issuing cost amount what here to 2 million. Now, ladies and gentlemen, listen to me very well. The 2 million issuing costs and the discounting costs are amortized evenly over the useful life of the bond. So the 2 million is supposed to be spread over the useful life. And the useful life happens to be how many years? Happens to be 10 years. It's a 10-year bond. So meaning that every year, these people will be allowing us, ladies and gentlemen, to be able to take a benefit of 2 divided by 10. 2 divided by 10 every year per annum. So what is 2 divided by 10? Somebody give me this figure. It is 0.2. 0.2. Remember, for tax benefit, the examiner normally will give you 3 qualifying expenses. And these qualifying expenses are which expenses? Number 1, we have interest will qualify for purposes of claiming your tax benefit interest. Number 2, we have issuing the cost. Those will qualify for purpose of you claiming the tax benefit. Number 3, we have the discount. So discount, this one is yours. Discount, this one is yours. So could you kindly give me the total discount first of all? Give me the total discount. Give me the total discount. Give me the total discount. Total discount from the question here, from the question paper, the old bond is given here. You can see the total discount is 2%. So it will be 2%, 2% of the par value. 2% of the par value, that is 100. Which means, ladies and gentlemen, that the total discount will be 2 bob in terms of millions. But again, don't forget that the amortization for discount, the amortization for issue costs is normally evenly over the useful life. So it means that even this one discount, because I want an annual thing, I must come and divide this by 10. I must come and divide this by 10. So could you kindly give me this answer? Issue or rather discount per annum. I'm getting discount per annum. You can even write here per annum for purposes of what year? For purposes of understanding later. So I can see straight away that this one also will come to 0.2. What year, somebody? 0.2. 0.2. So could you kindly give me the total qualifying expenditure? Give me the total qualifying expenditure. 16.4. 16.4 is the total qualifying expenditure of which the government can only allow you to claim the corporation tax rate of the total qualifying expenditure. The corporation tax rate has been given in the question as 40%. So what is 40% of 16.4? 40% of 16.4. 40% of 16.4 before I look at before I look at your comments. So I'm being given a figure of 6.56. So this 6.56, ladies and gentlemen, that we have here is a benefit. So what I'll be bleeding every year to be paying in form of an amount for this particular bond will be how much? So in this case here, the amount payable. So you can call this the net interest per annum. The net interest per annum, itakuja kuwe ngapi? Somebody 16 minus this 6.56. It will give us 9.44. It will give us 9.44. Ladies and gentlemen, remember I'm doing Roman 2. Roman 2 of this question before. Roman 2 of this question here before I start. Roman 2 of this question is quite categorical. Roman 2 wanted us to give them the annual cash flow savings. So what we have gotten here is annual cash flow, but for the old bond. So for you to be able to deduce the saving, you need to do the same analysis, but now this time around for the new bond. And of course, I would want to remain a little bit quiet to see whether there is anybody who will be able to do the same working, but now this time around for the new bond. The same ones zinafanana swali zote. The same for the new bond. From there, I would want somebody, as you do that, I would want to be going through your comments for the new bond. For the new bond. Naona Faith anasema mwalimu leo unaenda haraka. Relax, hata hujaanza bado kusoma swali. Mbona mko na wasiwasi? Relax. Wewe fuata tu. Hii ni kila mwanafunzi. Nimewambia ni swali ya high school. Hakuna mwanafunzi hataishika by the end of this lesson. Every student hataishika. It's the easiest. And I would even want the examiner to repeat it this time. If I'm the examiner, I'll repeat this question. Because it was done very poorly. In our that sitting. Very poorly. Mimi ningekuwa examiner. Hii ndio kwanza unapata question number 1 na max 12, sio kama ilikuwa 8. So the new bond. I just want the cash flow associated with the new bond. What do we have there? I can see so many of you writing good things here. The new bond. 16.4. Discount kindly repeat. Interest I'm being told is 12. Issue cost of 0.2. Okay. So let me answer that. Leo Peter Kinyumu amelalia masikio. Leo Peter Kinyumu hata nisaidie kujibu. Unaona, kwa hii question paper, ladies and gentlemen, what have they told us? They are telling us that in the second sentence, the bond was issued at 2% discount. So then what is the total discount that we gave out? The total discount will be 2% of the par value. So 2%, our par value is 100 million. So in terms of millions, that will be 100. 2% of 100 will be 2 bob. So the 2 bob is supposed to be amortized over the number of years of the bond. And remember, the bond has got how many years? It's a 10-year bond. So the 2 must be divided by 10. That's how I was able to get the 0.what year for the discount here, 0.2. The same case with the issue cost. You can see they have told us that the issuing cost amounted to how much? Issuing cost amounted to 2 million. But you see the 2 million can only be claimed evenly over the useful life of the bond. Or rather, the 2 million is for the 10 years. And yet, I want an annual figure. So the annual figure will be the 2 divided by what year? 10 years. The 2 divided by 10 years. How about this interest? How comes we never divided this by 10? It's because the rate of interest is on a per annum basis. The rate of interest, ladies and gentlemen, is on a per annum basis. The rate of interest is on a per annum basis. Not unless you're told otherwise. This 16%, this figure given here, coupon rate, is normally an annual percentage interest rate. Tuende pole pole tuone wanasema namna gani. So interest payable 14, just some net interest for the new bond. Great. Net interest for the new bond. Issue cost, I like that. I like this. Sasa wameanza kukamata. Nilikwambia by the end of the day, mimi najuanga ile vitu ngumu. Mimi najuanga ile, na nyinyi mlishapita nyinyi wote 100%. Ukishashika money markets, hivi vitu vingine kwa finance hakuna kitu uweze ukashika. Money markets ndio mbaya. Ukishashika hiyo, hii ni mswaki because ni kama kukram. Ni kama kukram. So the new bond, ladies and gentlemen, what do I have here? For this new bond as a finance manager, ladies and gentlemen, for the new bond, I'll be interested in knowing how much interest will I be paying every year for the new bond. This new bond that I would want to use for purposes of refinancing. For purposes of refinancing, ladies and gentlemen, I can see Pamela has gotten it right. Thank you. So information on the new bond is given here. Due to the decline in treasury bill rates in the recent past, interest rates in the money market have been falling, presenting favorable opportunities for refinancing. A financial analyst engaged by the company to assess the possibility of refinancing the debt reports that a new 100 million per value, 12%, 5-year bond could be issued to the company. So the interest is at 12%. So the interest is 12% per annum, 12% per annum times the par value, which is 100, which somebody gives me how much figure? 12. Remember, this is interest per annum. So from there come and the less, of course, ladies and gentlemen, tax benefits, the bond, ziko kibao. And that is why Modigliani and Miller were making an argument that you are always better off issuing a bond. You are always better off growing your company using loans. Because of what here? The tax benefits. And for the bond, we'll normally have 3 tax benefits. The first qualifying expense will be the interest itself. So the interest itself, the interest here is 12. And then we have the issue of what here? Issuing a cost. Issuing a cost per annum. So the issuing cost per annum, what do we have here? The issuing cost per annum for the new bond. What have they told us? They have told us 5-year bond could be issued by the company. Issuing cost for the new bond will be 5% of the par value. So 5% of the par value, which is 100. But for issuing cost, you have to be careful. Issuing cost is normally amortized over the useful life of the bond. And this particular bond has got how many years? Has got 5 years. So you divide this by 5 to get issuing cost per annum, which in this particular case, somebody gave me an answer. Somebody gave me an answer, issuing cost, 1 million. I'm being told 1 million. So I'll leave out the M, I'll only talk of 1 like that. Apart from that, kindly come and give me the discounting cost per annum. The discounting cost per annum, what do we have here? Discounting cost per annum for the new bond. For the new bond, I can see 0.6 throughout. 0.6 throughout. Only one student I've seen, Maalim, who has 0.4. I don't know how he got the 0.4, Maalim. Ladies and gentlemen, listen and listen to me very well. For the new bond, remember, information about the new bond is given here, where they have told us that the discount is 3%. 3% of the par value. Wanafunzi wote hawakoseangi hiyo. Wanafunzi wote watapata hii kitu ya discount. Watakwambia ni 3%. Watakwambia ni 3% of 100. 3% of 100 gives us what? Gives us 3. Unfortunately, kana kashetani, kana kupeleka kubaya, kana kuambia weka hapa 3. Ukishaweka hapa 3, kana kuambia the first person you call after the exam is mwalimu. Tell mwalimu how good that paper was. Napiga simu niambia mwalimu kunywa soda. Kama juzi kwa mwingine aliniambia nikiwa kule Isinya Friends Ranch, aliniambia mwalimu na kila mwanafunzi anakutumia 300, which was very good. Lakini mwalimu nataka wewe uchukue mzinga moja. Uniambie Paybill ni ngapi? Huyu hakujua mimi sikunywi. Maybe yule anaongea anazokela kunywa, sikunywi mambo yako wewe. Lakini asante sana. So kumbuka, discount has to be amortized evenly over the useful life. And as we mark these, we'll get some students out of poor reading, what are divided up on a 10 again. And yet, ladies and gentlemen, we have this discount will be amortized over the useful life of the bond, which is 5 years, divided by 5, which somebody is giving me what figure? 0.6. So could you kindly come and add all of them? Come and add all of them. 12 plus 1 plus 0.6. What do we have at the end of the day? 12 plus 1 plus 0.6. What do 13.6? 13 point? Thank you very much. 13.6. But remember, the government can never allow you to claim everything 100%. The government allows you to claim up to the corporation tax rate. You claim using the 40%. For this one, times 40%, please give me a figure. Times 40%, I can see 5.44. So this 5.44 is going to the opposite direction with the, remember that's a benefit, that's an outflow. So I'll talk of 12 minus 5.44 for me to be able to get, ladies and gentlemen, for me to be able to get the net interest payable. The net interest payable. So the net interest payable, I can see so many students who are giving me answers, 6.56. The net interest payable is 6.56 here. 6.56 here. Ladies and gentlemen, 6.56. I hope you have written here. This is a net interest payable. Now tell me, if you are the finance manager, which bond would you rather? Would you rather stick with your old bond, or in this case here, work with a new bond? Which bond would you rather work with? Which bond? The old, I can see people saying old, new bond, old bond is getting, in this case here, a lot of votes, old bond. Lydia says new. Lydia says new. I'm waiting for the last one. I'm waiting for the last one. Which bond as a finance manager would you want to work with? Which bond? Remember, this is about interest payable. And the lower the expense for me, the better. The better. The lower the expense for me, the better. So I can see for sure that the new bond is beneficial. The new bond is beneficial. So please give me the benefit, the savings. If I work with a new bond, please come and give me the savings. 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 The benefit of the new bond. The benefit of the new bond. So the benefit of the new bond, the benefit of the new bond, the benefit of the new bond will be 9.44 minus 6.56. Will be 9.44 minus 6.56, like that. Could you kindly give us an answer? Could you kindly give us an answer? Why am I picking the new bond? Because the net interest payable here is less, is lower. I'll be paying only 6.56 vis-a-vis compared to the old. You can see the old bond, I'm paying more. I'm paying more. I'm paying more. I hope I've answered your question. Carol tells me that the net benefit will be 2.88. 2.88. Sasa nataka unisikize na unisikize vizuri. This 2.88 is per annum, a benefit on an annual basis. A benefit on an annual basis. And that is why you are seeing in Roman 2. That is why you are seeing in Roman 3 actually, where they're asking you to calculate the net present value of the refinancing decision. The net present value of the refinancing, as you shall be seeing later on. When it comes to this particular net present value, what I will do for Roman 3, what I'll do for Roman 3, to get net present value, I will take this annuity benefit times PV4, These guys have given us, remember I will enjoy, listen and listen and listen. Listen. If I retire the old bond, at the middle, remember it was a 10-year bond, but somebody is saying that we need, it was a 10-year-old bond, but somebody is saying that we need to do what? Somebody is saying that we should retire it at the end of the 5th year. So if I retire it at the end of the 5th year, it means that I'll be enjoying this 2.88 every year. For how many years? I'll be enjoying the 2.88 every year. For how many years? For how many years? 5 years. 5 years. When I introduce the new bond. So this one here will be 5 years. 5 years. And at what cost of capital? 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 Somebody is giving me 12%, 12%, 12% cost of capital. Cost of capital, if I remember very well, we can never use any rate of interest. any rate of interest over any of the two bonds. The cost of capital will always be given by the examiner. The cost of capital will always be given by the examiner, and this was a lazy examiner. So you can see here, the after-tax cost of what? Debt. The after-tax KD. Remember, because this is a debt benefit, because it is a debt benefit, we can only discount it using a KD. We can only discount it using KD. And the KD given there is 7%. 7%. The KD given there is 7%. And then I'll come and subtract the initial outlay. So what have I done? I've realized that I'll be enjoying the 2.88 every year for how many years? 5 years. And that is why I've decided to discount this using present value, interest factor over an annuity over 5 years using a KD, because this is a debt benefit. So I would want a good student to be able to read this for me from your tables. Remember, we are using which tables? We are using the PVFA. Present value, interest factor of an annuity. First of all, the present value interest factor of an annuity table, does it have 7%? Does it have 7%? Patapotea, does it have 7%? Does it have 7%? Does it have 7%? Does it have 7%? It does. It does. I'm being given 4.1002. If I were you, because I'm so sure there will be so many students who will not be able to read that figure from their tables, I would even go circle that particular figure. I take a photo of it and then I send it to WhatsApp. Remember, this gospel is not an easy gospel. It's a gospel that you and I have to preach it together. Otherwise, I lose track. So try to make life easy for everybody. But I'm assuming, ladies and gentlemen, that all of us have been able to get that 4.1002. All of us. So we have here 2.88 times 4.1002. 4.1002. Now minus what we call the initial outlay. Minus the initial outlay. Now, ladies and gentlemen, thank you. Initial outlay ndio mali kuna kakibarua kidogo tu, hata kana noma. Initial outlay haina noma. So hii initial outlay ndio umeulizwa hapa in Roman 1. Check this. The initial investment required to issue the new bond. If we decide to issue the new bond today, what are those expenses we will incur today? What are those expenses we shall incur today? If we decide to issue the new bond, tukimaliza hii kusema ukweli, tunaenda tu kulala. Hakuna kufikiria mambo ingine. Tukimaliza hii, tunaenda tu kulala. So initial outlay, the initial outlay. I would want to remain silent a little bit for 2 minutes, so that you guys can try your best to give me this initial outlay. Hata ukishindwa, so what? Ndio sasa tupigane vita mimi na wewe, uniambie kwa nini ukuwatch video. Umeona mwanafunzi wa Jessica, huyu mwanafunzi ni hatari. Ameniambia kuna kitu hapa, hata huyu Mary ni hatari. Ameona kitu hapa mzuri sana. Aha. Hata wote kina Daisy. Unaona kama Daisy anasema hapa issue cost, hata Udorin, hata Ann, aya. Kwani hakuna mwanaume hata mmoja? Aya. Penalty Boniface, thank you very much. Umekuja in this case here, in the interest of the boy child, ukasaidia sana, ukajua kwamba should we decide to retire the old bond? Should we decide to issue a new bond today? In the initial investment, you have to be charged a penalty. So that penalty which you will pay is part of the initial investment. Then we have Peter Kinyumu saying, hey, the call premium. The call premium. James anasema pata potea. Asante sana. Easier said than done. Can you kindly compute those items you've told me? We have 4 items. Whenever it comes to initial investment, we have 4 items. And these 4 items, there is someone who told me the 4 items, we need to be capturing them using the mnemonic here, CODI. The mnemonic here, CODI. Anytime we think about the initial outlay of a bond, always think about CODI, where C stands for call premium. C stands for call premium. This stands for the overlapping interest. This stands for discount. This stands for discount. I stands for what here? Issue cost. And then the other thing you're supposed to know, in the initial investment, we don't amortize any cost. We don't amortize any cost because all the entire cost, here you'll be told to pay it up front. So always initial outlay, you think of totality. No amortization at all. No amortization at all. So I would want to really shift this ball to you. Wale ambao mnajua mpira, mshasikia kupepeta. Nimepepeta yangu kidogo, nimeshafikisha kama 40, nimepepeta 40, nimekurushia wewe. So nataka kuona vile unafanya na unapepeta mzuri. Bora ushike handball mzuri. Unipatie figures. Uniambie call premium ni ngapi? Because call premium lazima ulipe upfront. Call premium. I'm lost from the 2 call premium. Okay. So anasema 10. Today you are very fast. I don't know, and I'm thinking I'm doing my best. Share the question. Call premium. Tungangane tuone call premium. Call premium. What do we have there? Now, una block. Sawa. Mimi nataka tu call premium peke yake. So call premium, ladies and gentlemen, they have given us the percentage. The percentage wametuambia the old bond can be redeemed at 10% premium. So the owners of the old bond will tell you, hey, you want to cancel our bond? No problem. Give us something on top of the par value. And this something is 10%. Therefore, the call premium, ladies and gentlemen, the call premium will be 10% of the par value, which is 100 million. So 10% of 100 million, 10% of 100 million, 10% of 100 million, 10% of 100 million gives us what figure? Somebody here gives us 10. 10% of 100 million gives us 10. And you can see over 20 students got this right. And that is how I normally measure my speed. When I want to know whether I'm very fast, I look at the kind of answers I'm getting. So it will be very important that all of us just dive in for you to understand. It's a simple thing I told you. You could be saying that I'm fast, but you're the one, in this case, who's not really trying to put in enough efforts. Overlapping interest. Could you kindly give me the overlapping interest? Just go to information talking about overlapping interest. Just try your best and give it to me. Try and give it to me. There is nobody who is a slow learner. Overlapping interest. I'm waiting to see the overlapping interest. Andrew tells me 3, 3, 3, 3. James tells me 2. We have 16%, 2.67, 2.67, 2.67, 2.67. Now, ladies and gentlemen, let's go to overlapping interest. Overlapping interest, what do we have here for overlapping interest? We are told here that in addition, 2 months interest penalty will have to be paid on redemption. On redemption. Listen and listen and listen. Listen and listen and listen. For this older bond, for the old bond, what is the interest, the normal interest for the old bond? We are told it is 16%. So I will take 16% of the par value, which is 100. 16% of the par value, which is 100. But remember, once I get this 16% of 100, I'll get 16, which is interest for a whole year. But we are told the overlap will be an overlap of how many months? 2 months. An overlap of 2 months. So I'll have to come and take this. I multiply this with 2 over 12. So you multiply it with 2 over 12. 2 over 12. Listen and listen here. We are told in addition, there are 2 months interest penalty, which will have to be paid on redemption. On redemption. So you could either call this a penalty or what here, somebody, or an overlapping interest. So what do we have here, somebody? What do we have here, somebody? Please give me an answer. Please give me an answer. I'm being given 2.67. I'm being given here 2.67 like that. 2.67, 2.67, 2.67. Now, could we kindly pick again the next item? The next item here, which is quite tricky, is the discount. The discount that has to be paid immediately. The discount that has to be paid immediately. The discount which has to be paid immediately. If we are going to issue this 5-year bond today, if we are going to issue this 5-year bond today, what is going to happen with the discount? Please guess an answer. Please guess an answer. Guess an answer. Guess an answer. Please guess an answer. Guess an answer. Just try guessing. Just try guessing. When you guess like that, you try putting in your best foot forward, you'll understand something. So I'm being told here 3 3 zimekuwa mingi, kidogo kidogo zikaanza 5 5. And I like mwanafunzi wetu Huawei. Alikuwa amesema mwanzo analia sana, lakini saa hizi ameanza kupatiana fika na amepata correct. Thank you very much. Thank you very much. Aya. Sasa nataka mnisikize na mnisikize makini sana. Unajua, tukitaka kuissue this new bond, my great students, tukitaka kuissue this new bond, initially, at this particular juncture of retiring the old bond, we have to issue this new bond at a discount. So remember, discount is like you are giving the buyers some money. So upfront. So the discount, kindly give me the discount. So this discount has to be discount of the new. What tunasema namna discount of the new bond. Na what tunasema issue of the new bond. Issue of the new bond. Issue cost of the new bond. The first 2 are for the old bond. The first 2 are for the old bond. These other 2 are for the new bond. These other 2 are for the new bond. So give me the discount, because initially when I want to refinance, when I want to retire the old bond, I will be required to pay a discount for the new bond. And discount for the new bond, what do I have here? Discount for the new bond, ladies and gentlemen. They have given me the discount for the new bond. They have given me the discount for the new bond. This new bond, it's a 5-year bond, could be issued. Let me just take this out. Okay. So this new bond here could be issued. The new bond could be issued by the company. Issuing cost for the new bond is 5% of the par value. And then we have 3%. 3% is the discount for the new bond. So it will be 3%. It will be 3%, 3%, 3% of the par value, which is 100. 3% of the par value, which is 100. Thank you very much for participating. Thank you very much for participating. Thank you very much for participating. So, kumbukeni, katika this initial outlay, we are working with the total figures. Initial outlay, ladies and gentlemen, we don't do what? We don't amortize. If I were you, I would have written that thing somewhere in my mother tongue. Initial cost, initial outlay, we don't amortize, and it's totality, total figure. So 3% over 100, this gives me what figure, somebody here? 3, Bob. This gives me a figure of 3. From there, give me the issue cost very fast for the new bond. Issue cost are 5%. So 5% over 100. 5% over 100. Issue cost will be 5% over 100. So we have here 5% of 100. So 5% of 100, what do we have there? 5. So could you kindly give me the total here? Kindly give me the total figure. So anytime we talk of initial outlay, my great students, always think about CODI. Think about CODI. Always you think about CODI. You think about CODI. So I'm being given a figure of 20.67. 20.67. Ladies and gentlemen, one thing that makes me love these discounts is that our government is very considerate about bond issuers. Very considerate about bond issuers. Every time you do some small analysis, you must come and talk of what? The tax benefits. So say there, less tax benefit. You less the tax benefit. You less the tax benefit. You less the tax benefit. As I look for a better marker pen, the tax benefit, we normally use this acronym of COU, like this. I discovered for the initial outlay, giving these students this mnemonic here works for them, works for them, works for them. So the tax benefits, the qualifying expenditure, the total call premium will qualify. So we have here the first tax benefit is the call premium. The first qualifying expenditure is the call premium, which is 10. And then, of course, we have O is the overlapping interest. This one here, the government will again promote you by allowing you to claim. It's a qualifying expenditure. So the overlapping interest is 2.67. The overlapping interest is 2.67. Maana confusion ukujia kidogo ni hapa kwa U. Hii inaitwa unamortized. So please mention there in full, unamortized. Unamortized discount cost. And this is an amortized issue cost. Unamortized. Unamortized discount cost and an amortized issue cost. And then the other thing that will be very important for us to note is that here, everything that we pick here is for the old bond. It's for the old bond. Everything. In the tax benefit COU, everything is on the old bond. Everything is on the old bond. So, ladies and gentlemen, please come and bear with me here. I would want us to get the unamortized. I would want us to get the unamortized discount. Unamortized discount. I would want to see whether there is any student who will be able to give me this figure correctly. The unamortized discount. Unamortized discount. Let me see whether there is any student who will be able to give me the annual boy tells me 1 million. Then we have Peter telling me 2 million. 2 million. Unamortized. Faith tells me 2 million. Mary says 1 million. Pata potea. Go to the discount of the old bond. Discount 1 million. That 1 million seems 2 million. 2 million. Thank you. Let me do it. Let me do this. Let me do this. Let me do this. Thank you very much. That 2 million seems correct. Let's see. Now, listen and listen and listen. We are told up here, this old bond information is given up here. The bond was issued how many years ago? 10 years ago. And the bond was issued at what discount? 2% discount. So 2% of what year? 2%, it is 2% of the par value. 2% of the par value. It is 2% of the par value. It is 2% of the par value, which is 100. So 2% of 100, that gives us what here, somebody? 2. But now, ladies and gentlemen, remember that this is a 10-year bond. By the time you would want to issue a new bond, 5 years would have lapsed. 5 years here would be lapsing 5 years, and will be left with how many years here which will not have amortized? 5 years. Listen and listen here. These two you have gotten here. We are told that the first 5 years here will lapse. So the amortized, what I'll have taken to my income statement will be 5 years discount. So the amortized will be 5/10 times this 2, which gives me 1 million. How about an amortized? An amortized will be the 5 remaining over 10 times 2, which gives me what figure, somebody there? Which gives me 1. Remember, we are talking of an amortized. After we issue this new bond, how many years do we have moving forward? So we have here an amortized. We have an amortized discount, which somebody tells me is 1. They're in millions, my figures. So go to the fourth one, the unamortized issue cost. What that one? Unamortized issue cost. Unamortized issue cost. Remember the issue cost, already we have been given the total issue cost. The total issue cost, thank you very much, Dennis. The total issue cost, they've already given us the total issue cost of the old bond. It was what year? 2 million over 10 years. But remember, at the middle of this bond, we are going to reissue a new bond. So meaning that the first 5 years would have lapsed and would have taken every year. The amortized issue cost will be left again with 5/10. So the unamortized issue cost, ni 1. So hebu niongezee zote hizo zitakuja ngapi somebody? Hebu niongezee hizo zote zitakuja ngapi somebody? Niongezee hizo zote uniambie zitakuja ngapi? Niongezee hizo zote uniambie zitakuja ngapi somebody? The total qualifying expenditure from 14.6 I'm being told. Benedict Kirui tells us 14.6. Remember, out of this 14.6, we'll only recognize 40%. So what is 40% of that 14.6? 14.67, others are telling me 14.67, fine. What is 40% of 14.67? Somebody give me a figure. 40%. 40%. I'm being given 5.8887. Let me wait for others. 5.68. Let's put 5.5. Let's put here 5.87. So could you kindly then subtract this? Could you kindly subtract the benefit out of our expenditure for you to be able to get the initial cost? For you to be able to get the initial cost, kindly come here and subtract that 20.67 minus 5.87. That will end up giving us what initial cost? Initial cost. So initial cost oye wengi waongei. Initial cost itakuja kuwe ngapi oye initial cost? Number 14 point what year? 14.8 from Massimo Tai, 14.80. Thank you and thank you very much. Itarudia tena. Ni noma kidogo lakini itarudia tena. Lakini most importantly is you to remember our acronyms. CODI, CO. CODI and the CO. But I'll repeat again. I'll repeat again. Now, before I repeat, I would want someone to make reference to our NPV and finish our NPV computation. Finish our NPV computation where we had the initial outlay, put this figure. Remember, initial outlay is never discounted. It's never discounted. So, ladies and gentlemen, to get my NPV, if I can recall, we had a 2.88 times the PV-FAR. PV-FAR, you guys had given me a figure like 4 point something. You guys had given me a figure like 4 point something. PV-FAR ilikuwa inakuja ngapi? PV-FAR ilikuwa inakuja ngapi? Present value interest factor of an annuity. Please remind mwalimu, PV-FAR ilikuwa inakuja ngapi? 4.1002. So times 4.1002 minus the initial outlay, which is 14 point what year? 14.8 like that. Of which I've seen already somebody has given me a net present value ya ngapi? Aki haiwezi kuwa negative. Kweli? Naambua negative, inasema negative. Or negative, Negative 2.991. Negative 2.991. So inakuja negative 2.991. And of course, any project whose NPV is negative is a bad project. So in this case here, we are better off not redeeming. We are better off not redeeming. So in this case here, tell us that redemption is not viable. Redemption is not viable. Because of negative NPV, it makes the entire process to be what here? To be null and void. Makes the entire process to be null and void. Great. Breathe in. Take a deep breath. Breathe in. Great. Great. Great, 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 great. Sasa, ladies and gentlemen, iko mwanafunzi ameshikanisha chochote kweli. Hiyo swali out of say 12 marks. Ukiambiwa urudie, can you get, for example, 6 out of 12? Ukiambiwa urudie swali, can you get 6 out of 12? Can you get 6 out of 12? Then you must be a very bright student, because normally when I do this mathematics, and that is why you saw I was a little bit rough, kwa sababu alikuwa anauliza maswali, sikutaka kushinda iende lesson 2. Nilikuwa nataka nikimbie kwanza ishe, you pick a few things here and there. And then if you don't mind, maybe you ask on a few areas which you would want me to repeat, but I would really beg you, ukiwa peke yako, uweke solution kando, urudie kitu peke yako, alafu ikiwezekana in my next class, I should be able to repeat again this thing of bond refinance. It's not a very easy thing for very many students. It's not a very easy thing for very many students. If you prefer the old bond, always, will the NPV be negative? No. Hii NPV nile kichange. Kwa hiyo nilikuwa nimewafanyia kwa normal class. Mary amesema no, you can't get 6. Wala ambao wanasema no ndio wengi, Wala wanasema no ndio wengi. Haya. Wala wanasema no, ulizeni maswali sasa. Sasa uliza maswali. Ndio ukienda kurudia peke yako, because mimi hata kama nasema ni ngumu, sioni kama kuna kitu ngumu yoyote. So long as you understand the tax benefit. So long as you need 2 more questions from this, great. Ningeona kama 5 marks. below 50%? 50%, below 50%, that is not my student, Peter. You can't get below 50% and you say that you are my student. No. It has to be more than. It has to be more than. Yes, CO is always for the old bond. CO is always for the old bond. Aya, wacha nikuambie siri. Siri hapa ni kitu ya maana sana hapa. Ukishajua siri, ushajua hesabu yote hii bonds. Ukipatiwa swali kama hii, always, hapana anza na number 1. Anza na ina kuuliza annual cash flow savings, if any, expected from the bond refinancing. And how do you do this? Just calculate the interest for the old bond, and you give us the tax benefits therein. the tax benefits we have. So allow mwalimu to repeat this very fast. So Roman 2, annual. Annual means what year? Per year. So nitakuja hapa nimwandikie old bond. Nimwandikie old bond. So nikiandika old bond hapa sasa, nitapata marks zote kusema ukweli. Nikiandika old bond, nitapata marks zote kusema ukweli. So nikiandika old bond, so every year as a finance manager, in the old bond, what do I expect? Of course, I know my obligation. My obligation is to pay interest for these bonds. My obligation is to pay interest for these bonds. So the first thing that I will do is to come and think about the interest payable. So I'll mention there the interest payable every year, of which these people have told you in the old bond, what do we have? In the old bond, what do we have? In the old bond, what do we have? They have told us a motor vehicle company issued a 10-year, 16%, of course, this is 16% per annum. This is the rate of interest, 16% of the total par value. So 16% of 100, 16% of 100. So I'll talk of 16% of 100, which will give us how much here, somebody? 16. But as I pay interest, I remember Modigliani and Miller. They said that bonds have got so many advantages. And these many advantages, ladies and gentlemen, of bonds is as regards what here? The tax benefits. So it'll come and give us here less the tax benefits. So less TB, tax benefit. Of course, tax benefit, you have to look at the qualifying expenditure, the qualifying expenses. The very first qualifying expense is the ile interest ambayo unalipa hapa inapita kwa tax bracket, inaingia kule, wana deduct profit, inakubalika. So the first tax qualifying expense here will be the interest itself. Interest itself. Interest, which is what year 16. The other one will be the discount. The other one will be the issue cost. So tajiuliza kwa hii old bond, discount ni ngapi? Discount ni ngapi? Old bond, discount ni ngapi? Nikija hapa kwa old bond, discount, ladies and gentlemen, itakuwa ngapi? Nimeambiwa vizuri. The bond was issued at 2% discount. So what is this discount amount? It will be 2% of the par value, which is 100. So 2% of 100 is 2 bob. But remember, discount and issue cost ni kama depreciation. Lazima divide na useful life ndio kupata annual. So that 2 must be divided by 10, which gives me what discount here, which gives me 0.2 like that. Ladies and gentlemen, remember it's a discount per annum. And then this as well will be issue cost per annum. The issue cost that I have here for the old is 2 million. So 2 million is for 10 years, so divide by 10. So again, the issue cost will be 0.2 what here will be 0.2. Will be 0.2. So please come and add for me. This one add easy. Inakuja 16.4. After you get the total qualifying expenditure, multiply it with the tax, corporate tax rate, which is 40%. Which is 40%. So it would score 16.4 times 40%. Nisaidie figure jameni. Nisaidie figure jameni. 16.4 times 40%. That will give us what figure? That gives us 6.56. 6.56. So once I get this 6.56, remember this is a benefit. It's a benefit. We don't expect it to go to the same, to go with this on the same direction. Either we decide, we say negative, we go positive. But the very best way, because this will always be bigger, come and just deduct the benefit like that. For you to be able to get the net what here? The net interest. For you to get the net interest. So kichukua 16 minus 6.56, what figure do we have there, somebody? We have 9.44. The figure that we have here is 9.44 like that. Now, once you get that, come and give us the new bond. The new bond. Come here, give us a new, start with the interest per annum of the new bond. The interest per annum of the new bond, the interest per annum of the new bond, interest per annum of the new bond. Already we have our new bond percentage. So our new bond percentage is given here due to the decline in treasury bill rates in the recent past. Interest rates in the money market have been falling, presenting favorable opportunities for refinancing. A financial analyst engaged by the company to assess the possibility of refinancing the debt reports that a new shillings, 100 million par value, 12% is our interest rate. So 12% times 100 gives us how much here? It gives us 12. And then now we have the tax benefits. The tax benefit, the first one is the interest. Interest itself, you take the 12, the one that you have there. From there, come and they give us the discount. Is there anybody who is able to see the discount there? Is there anybody who is able to see the discount? So discount of the new bond. Discount of the new bond, ladies and gentlemen, the discount of the new bond is 3%. 3% of 100 million. So 3% of 100, that will give me 3. So remember, discount and issue cost must always be divided by the number of years. The number of years here are how many? There are 5. So could you kindly take 3 divided by 5? 3 divided by 5, I'm being given 0.what here? 6, like that. 3 divided by 5, I'm getting 0.6. From there, issue cost of the new bond they have told us is 5. So 5% of 100, that's 5. So what is 5 divided by 5? What is 5 divided by 5? I'm able to get my issue costs very easily. I'm able to get my issue cost here very easily. So long as you remember that here the examiner wants annuity. So then this will be 1. So could you kindly combine these 3? This will give me 13 point what here, somebody? Is it 13.6? Once I have there 13.6, I'll come and multiply this with 40% to get the tax benefit. So what is 13.6 times 40%? Somebody help me out. 13.6 times 0.4 will end up giving me what figure? Will end up giving me 5.44. Will end up giving me 5.44, like that. So this tax benefit, I deduct it from the interest which I have to pay every year. So then what is 12 minus 5.44, somebody? What is 12 minus 5.44? It gives me 6.56. So you can see that if I go the new bond way, I'll be paying 6.56. If I remain with the old bond, I'll be paying 9.44 because at the end of the day, I left the paying figure to be positive. So this is a higher payment. So in that case here, then what is the benefit of running on with the new bond? The benefit will be the difference between these two, the difference. So the annual benefit, 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 the annual benefit will be the difference between the two. The annual benefit of the new bond will be 9.44 minus 6.56, like that. So please give us an answer. Give us an answer. Please give us an answer. 9.44 minus 6.56. That is how we got the 2.88. That is how we got the 2.88. Remember, this is per what? Per annum. So if later on they want me to change this to a net present value, like how they want us to do it in Roman 3, I'll come and take 2.88 per annum times PV4 minus initial what here? Initial outlay. Remember, this is present value, interest what here? Factor, interest factor of an annuity. Present value, interest factor of an annuity. And remember, this benefit, we shall only stay with it for how many years? For 5 years. We shall only stay with it for 5 years. Why? Because we have our 10-year bond. In a few katikati 5 years, tuna surrender the bond. And then now the benefit we enjoy for having surrendered the old bond, we enjoy the benefit for 5 years. So this PVFA is for 5 years at the KD, cost of debt given, which is 7%. Cost of debt given, which is 7%. So now I hope, Susan, you are able to see where I got the 2.88 from. Susan, if you are still with us, are you able to see where we got the 2.88 from? Yeah, great. So ladies and gentlemen, PVFA, of course, you know how to read the PVFA. So that is it. Sasa after umefanya hiyo, nisikize kitu, hata usipoendelea mbele, acha nikwambie. Hata usipoendelea mbele. Unaona hii? Hii annual cash flow savings uko na max ngapi? 4. Ukuje uanze kufanya kitu ya NPV, hata kama utamaliza utapata kakitu, hata kama ni 0.5. Hapa unaweza kuja tu guess, unakuja na guess. Unajua kitu ya advice inakuwa mzuri sana. Advice unatumia nevertheless. Unaweza mwambia the old bond is viable. Sababu hujui cha yake, anamwambia the old bond is viable. Nevertheless, I would have preferred the new bond. In the process you can get a confused examiner. Mwenye atasoma the entire statement, akupatie mark moja na unavuka. Ukishavuka utakuja kujua some of these things ukiendelea mbele. Now let me read the comments here. I can see comments coming in. Yeah, great. So unasema rudia hizo za unamortized. So assuming the benefit was for the old bond, we'll use 10 years or 5 years remaining. I'm not able to get this question very well. Regardless, ladies and gentlemen, I don't know whether I'm the one who is not able to get it very well, but regardless, when it comes for the benefit, when it comes to this benefit, how are you looking at this benefit? You know, the benefit, listen and listen, listen and listen, listen and listen, listen and listen here. We are saying that if we continue with our 10-year bond, where every year, the last 5 years, ungeendelea kulipa 9.44, 9.44 etc. Hii yote 9.44, 9.44. But now the new bond ambayo itaanzia hapa kwenda mbele, utakuwa unalipa ile kitu ilikuwa kidogo, 6.56 hapa. 6.56, 6.56. Meaning kwamba for the remaining number of years, utakuwa unapata benefit ya 2.8. Always, ladies and gentlemen, whenever it comes to present valuation benefit, you look at the 2.8 you'll be getting, 88 you'll be getting for the remaining life. For the remaining life. For the remaining life of the old bond. Remaining life of the old bond. Yeah. Very good. Asante wanasaidia kujibu. Now, for co, will you use 10 years or 5 years? And the kodi, inahitaji kujituma. I like your advice. Yeah, custom is about that. Unaika hiyo kitu conjunctions, unamdanganya. However, moreover, nevertheless, unaziweka zote ile kizungu ulijua kabisa high school. Unaziweka zote. Now, ladies and gentlemen, let me repeat this thing over kodi. Equity initial outlay as we go to sleep. Equity initial outlay. Uko na hizo answers zote. Ile kitu unajua pia AFM in most cases for the number of years that I've taught AFM. AFM to a bigger extent is about your confidence as well. Confidence is key. Now, for example, tumesema namna gani? Tumesema hapa katika initial outlay. Tumesema tunaangalia totality. So tukasema jambo la kwanza hapa juu totality, utumie kodi. Totality. So kodi ya kwanza hapa ni call premium. Hapa tuko na overlapping what? Overlapping interest. Hapa tuko na discount. Discount ya gani? Somebody ya new. Hapa tuko na issue cost ya nini? Ya new. Na tukasema jameni, sababu ya totality, hapa hakuna kudivide na 10, hakuna kudivide na nothing. So kama ni call premium, wamekuambia call premium ni nini? Wamekuambia call premium. Wamesema call premium, wamekuambia hapa. The old bond can be redeemed at 10% premium and in addition 2 months. So 10% premium, very easy. Utakuja useme 10% of 100. 10% of 100, which will end up giving us what there? 10. Overlapping interest, remember these two. Tulisema hizi mbili ni gani? Somebody is old. Hizo mbili ni za old. Remember hizo mbili ni za old. The first two is za old. So call premium, tumesema ni 10. How about overlapping interest? Old bond interest. Old bond interest, ladies and gentlemen, the old bond interest, walikuwa wamesema hapa juu ni 16%. So my work will be take this 16% times 100, but remember the overlap is not for a whole year. the overlap is only for 2 months. The overlap is for 2 months. Because before you redeem this money to the old bondholders, you need to start issuing the new bonds first for a period of say 2 months. Uokote pesa kwanza ndio urudi. So kutakuwa na ile overlapping interest, and the overlapping interest that we normally penalized with is the old interest, the old bond. So kwa hivyo itakuwa 16% of 100 times 2 over what year? 2 over 12. After that, utakuja jiulize, initially today, if I'm to issue a new bond, lazima ndachapwa discount. Discount is a cost on my side. Discount is a cost on my side. Discount is a cost on my side, and it's discount of the new because I want to issue today. And the issue cost I want to issue today as well. So ladies and gentlemen, that is it. Mimi ningetaka uende ungangane na hiyo swali kabisa. Unless kuna maswali mengine. Aha. Okay. Unajua hii hesabu haina mambo ati sijui ya new bond being mover. Hata utakuja kujua bond gani iko viable wakati umemaliza hesabu. So hakuna at any point utakuja kusema that now we are dealing with a new bond which is viable, let us prorate. Nothing like that. Nothing like that. Wewe ushike tu straight away kwamba hapa juu equal premium, overlapping interest is an old bond. Discount, new bond. Issue, new bond. New bond. Ukienda pale kwa tax benefit straight away, kama ni hapa kwa tax benefit, unakumbuka tax benefit, ladies and gentlemen, tax benefit, ladies and gentlemen, tulisema ni call. Call, what do you have? The call premium will pick the figure that you have here. Overlapping interest will pick the figure that you have up there. Unakuja hapo unajiuliza, what is the unamortized discount? Remember, under call, it is always what here? The old bond information. Under call, we are looking at the old bond information. Now listen. Listen here. Under call, what are we saying here? Listen. Under call, ladies and gentlemen, an amortized discount. An amortized discount. An amortized discount. So an amortized discount of the old bond. What do I do? Somebody asked me to repeat this. For the old bond, look at, for example, this issuing cost, 2 million, of which I'll be amortizing every year. And by the time I'm bringing this old bond, I'll already have eaten 5 years. I'll have amortized this thing for 5 years. So then it means it's 50-50, amortized 50% and amortized 50%. That's how I was able to get that to 1-1-1. Asanteni sana, muache uoga. Ile kitu iko, usifikirie sana. Hiki tutaki kufikiria sana pia. Ukifikiria sana inakuwa international